Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, investment consultants, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out our website at dakota.com. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am thrilled to introduce our audience today to Anthony Minopoli, President and Chief Investment Officer of the Knights of Columbus Asset Advisors. Tony, welcome to Philadelphia.
Well, thank you for having me.
It's wonderful to have you here. It's also wonderful to have my partner in crime, Dan DiDomenico from Dakota.
Robert.
Thank you for being here.
Thank you, Robert. Thank you, Tony. Pleasure to be here.
Absolutely. We're looking forward to it. Before we get started, Tony, I'm going to read your biography for the audience.
Excellent.
Anthony Minopoli joined Knights of Columbus in 2005 and is responsible for the day-to-day management of the Knights' general account investment portfolio and mutual fund strategies. Anthony is also responsible for overseeing the internal investment staff, fixed income, and preferred stock investment strategy. In his role as CIO, Anthony provides oversight for the investment managers in the Knights' defined benefit pension plan, defined contribution plan, and charitable assets, all of which are externally managed. Prior to joining Knights of Columbus, Anthony spent 18 years at Evaluation Associates, with the last 10 years in the role of senior consultant. He worked with a wide array of pension and foundation clients, from Colgate-Palmolive to the National Football League. Anthony's community leadership includes board positions with the National Shrine of the Immaculate Conception, a religious order, multiple Catholic schools, and other community foundations. He received both his BS in finance and his MBA from the University of Bridgeport and is a member of Beta Gamma Sigma, the Honor Society for Collegiate Schools of Business. Most importantly, he calls Connecticut home with his family. Again, thank you for being here. Congratulations on all your success.
Oh, thank you. Thanks again for having me.
It feels like a long time since those days in 2002. I was sitting across from you and your client, Colgate-Palmolive,
That's right.
Trying to pretend like I knew what I was talking about.
As was I, so that made us even.
Good, and we both bought it, or at least
Absolutely.
we faked it until we made it.
Or maybe they bought it.
I think
even
may
more
have.
importantly.
I think they did, but I appreciated those days, and I'm grateful to be sitting across from
thank
you
you
2 decades later, and always, Dan, to have you here as well. Thank you so much for being here.
Thank you.
So I did have a question for you to get us started. I teach at Drexel. It's a co-op college. Why are co-ops important to you?
Well, co-ops really what launched me in my career. So I went to Fairfield Prep, which is the college prep school at Fairfield University, and I went to my safety school. And I went to the University of Bridgeport because they had a co-op program close to my family. I knew I was going to want to end up in Connecticut. And I had an accounting professor that was my advisor. And I thought I wanted to go into financial controls, maybe like controller, maybe one day even work up to CFO. And Professor Ben Cobalella, who was an accounting professor at UB, said, no, I want you to go to this investment advisory firm in Westport, Connecticut. My dad is an immigrant electrician. My dad came here at the age of 16 in 1955. I grew up in Bridgeport, Connecticut. I knew nothing of the stock market. I was there for 3 weeks and I'm home. And that was it. And I stayed there. So what I ended up doing, I spent that first summer, the summer of 87. So I got to witness the 87 stock crash as a young meatball kid that didn't know anything. And what I did is I worked at the shop Monday, Wednesday, Friday, and squeezed all of my classes into Tuesdays and Thursdays. And somehow was able to do that sophomore, junior, and senior year. So I had a completely atypical college experience, but the co-op experience was so invaluable. And quite candidly, I don't think I would have had the ability and the experience to become a CIO at the age of 37 without all of that experience that I had. And as you know, internships, I'm sure you help your students all the time, that if they're not doing co-op, they're a beast to get. So having that co-op experience is just so invaluable.
That's wonderful. Thank you for sharing that. Sure. So when you think about those years at Evaluation Associates, what were some of those early lessons that you learned that you took forward with you in your career?
Yeah, the interesting thing, the beauty of being at a firm like EAI, we were at the time probably at our peak, maybe the fourth largest consulting firm in the US. So in any given week, we could have 40 or 50 managers coming through our office. So I got to know, meet, befriend, and learn from people like Jeff Gunlock, Dan Fuss at Loomis Sales. I mean, really big luminaries in the business. And Dan, I would remember, would come to our office every year. He would make sort of a pilgrimage down to EAI. And the New Hampshire retirement system was an old client of mine, and he ran money. Loomis ran money for them. And I remember him saying in one meeting, I remember this guy when he was starting out, he didn't even know the right questions to ask. So you really got to learn from some pretty amazing people.
That's a great experience. Well, now you've been with Knights of Columbus for almost 20 years. So for our audience who might be less familiar with the organization and the mission of the business, would you mind sharing an overview?
Sure. We're going to start in 1882. I promise we're not going to go year by year.
Hold on, let me check the clock. Roberto, how are we doing with time?
But Father Michael McGivney started the Knights in 1882 in New Haven, which is why we're still headquartered there. And it was really for Irish Catholic, Irish American Catholic, Italian American Catholic that were building up the infrastructure in Connecticut and leaving widows and orphans. And it was literally kind of a pass the hat sort of situation. Records and lore say that about 1901, we became an actuarial-based life insurance company like anyone you would know. So fast forward to today, we have $125 billion of life insurance in force, about $8 billion of annuities. The mutual fund company is a little over $3 billion in assets. We have over 2.1 million members worldwide. And generally, people don't understand or appreciate the size and heft of the financial services side of the organization. But according to P&I think last year we ranked number 154. So I don't think we're going to take on BlackRock anytime soon, but we're pretty pleased with our growth.
Not that you're looking at the numbers.
No.
That's great. Well, we're going to spend most of our time today on those externally focused assets.
Sure.
So when you think about that portfolio, the strategic allocation, how has it changed over time when you think of kind of the evolution of those assets?
So when I got to the Knights in 2005, one of the things that they were interested in was that I had a background in alternative investing from my time at EAI. So as it would only take place in a good Catholic organization, it took me 5 years of missionary work and I suppose the great financial crisis to actually get investment number one into the alt portfolio. Mm-hmm. And that was actually with Oaktree. And I always chuckle about this because Howard Marks was another guy I met when I was at EAI. And I was meeting in New York and Howard was in, and we were looking at their mezzanine debt strategy, and it had an A-B structure. So the A notes received a 10% coupon, but were completely credit enhanced by the B notes. So my thought was, first foray into alts, great to have a bunch of credit enhancement, but we have Catholic investment guidelines. So here I am from the Knights of Columbus negotiating the need for my Catholic guidelines with my nice Jewish friend, Howard Marks. And it couldn't have worked out better. And that was really the start of our foray into alts, which are now about 2.4 billion committed and about 1.6 billion invested. So it's become quite a big portfolio for us.
Tony, thank you for sharing all that. So when you're setting the stage, so setting the agenda from an asset allocation perspective as CIO, what does that process look like? Are you using an external consultant?
So for the general account, no. And part of that is, as you know, I spent many years of my career in that business. Our pension plan is about 800 million, excuse me. We throw billions around like they're, nickels now. 800 million. And we use Cowen Associates. Angel Haddad out of the New Jersey office has been our consultant. So maybe we'll talk about the general account first. As a life insurance company, the preponderance of our assets are in fixed income. And the reason for that is that nothing hedges an insurance portfolio like bonds. But we do use, so that's about 83% of the assets. And then we allocate to equities, alternatives, real estate, and then about 6% of our assets are in policy loans, people literally taking loans against their policies. So the other assets that we invest in within the general account are really meant to provide income and diversification away from a bond portfolio. Now, when you flip the page and you look at our pension fund, we're still active to an extent. In January 22, we froze the pension plan to new entrants. Now, the fact that I'm sitting here, I'm still earning pension credits because I fall in the good old defined benefit plan. But we changed over to a fairly generous cash balance plan for our new employees. So we have been working with Callan on glide pathing our defined benefit plan, because what's happening is that between separations, people either retiring or people moving on to other opportunities, the nature of the plan is beginning to change. So for the traditional DB assets, we're beginning to move more and more into an immunized fixed income portfolio that's managed for us by Income Research and Management out of Boston. The cash balance plan is interesting because we provide a base amount based on people's salaries. So if you worked for us, Robert, we wouldn't take that out of your comp. We put that in there. But then there's a 4% crediting rate. And now that that's getting large enough, and given where interest rates are, what we're looking at right now is a consideration of about 80% of that to be in treasuries and agencies, and maybe very high quality, non-callable corporates. But the other 20% to be in senior secured lending because of the very high yields there. And just on a ratio basis, sort of 80-20, we can get to about a 580 yield. So if you remember, I said we were going to credit 4%. That 580 will give us an ability to build a cushion that if interest rates were to come down hard again, I hope they don't, but if they were to come down super hard again, we have some dollars to help offset it. But secondarily, if we do end up longer term with a much larger cushion, it could give us the opportunity to enhance the benefit. So it gives us a bit of optionality.
That makes sense. How about public equities? When you think about the public equity allocation, how are you thinking about U.S., domestic versus non-U.S.? We got to know each other on the international side, so I'd be curious what your thoughts are there.
So I've been battling because unless you've been relatively large cap and relatively growth, it's been pretty hard to make money these last few years. This year thus far, certainly, 2.5, 2.75 months doesn't make a trend, but international equity has made a very, very strong rebound. And we continue to think that when you have developed and emerging markets, adding in roughly 7,000 publicly traded securities, and then you have small cap, that gives you an ability to provide a level of diversification to just being, large cap and growth. And take it a step further, we tend to be more actively managed, mainly because I will make a strong case that passive is an active decision. I mean, you are deciding which index to select. We all know about the Magnificent Seven, but for the last probably 4 or 5 years, these large cap indices have grown more and more concentrated. And my argument to our committee is that if I said to you, we're going to hire a manager whose basic strategy is to buy more of the stocks that went up yesterday with no regard to what they do, that's probably not someone we're going to hire. And I'm not saying passive doesn't have a place, but I do think people have to think about passive in the lens of what active decisions am I making when I choose to make the passive decision.
Yeah, makes sense. I'm reading Charlie Ellis's new book. He makes a very compelling case for passive. So we'll have to read that, have you back on in a couple of months.
I would love to, because the one thing I will say, and I'll plant this in your head as you're reading it, if you think about stocks, I mean, last year, depending on the strategy, up roughly 25%. If you're paying an active manager 60 basis points for our large or large strategy, large cap, it's 45 basis points versus let's say 2 for passive. That's a pretty small piece of the overall potential return in equities. So I always think of the fee as the part of the iceberg that's above the water and the opportunity set to be everything that you can't see. So I would just think about that as you're reading Mr. Ellis's book.
I will. I appreciate that.
Excellent.
Thank you, Tony.
And I love your comments just in terms of thinking about active versus passive, but then when evaluating those active managers, not just based off a fee, but the opportunity set below. How do you get into, when thinking about the evaluation of the potential, the skill of those managers? Are there certain criteria, qualities that you're looking for?
Very much so. Maybe because I'm a bond guy at heart, I tend to be a bit more valuation sensitive, but I do try to find managers that have a process that can be replicated. And I just guest lectured at a friend's class at UConn. And one of the students asked me a question about, do you adapt your philosophy based on the most current happenings in the market? And I think an undergraduate finance student would ask that question. And the reality of it is, with horror, I think, in my voice, like, absolutely not. We try to find people that have a discipline. And we want that discipline to be, what is it that helps you decide to purchase? And more often than not, we're drawn to people that are focused, even if it's a growth strategy, understanding intrinsic value. Why is that stock attractive? Even working for a Catholic organization, I don't think any company has a divine right to be, right? So you want to find those companies that have a very strong, what's driving them? What's driving their earnings? What are they number 1 or 2 in their market? How is management? What's the new product mix look like? What things are they doing to ensure where they're going to be? And if I can give you a quick example, though it's not a growth stock, it's actually a value stock. It was Ford. So going into the financial crisis, Ford took it on the chin, the bonds got downgraded, and we took a step back and said, what's going on here? We loved management. They were coming out with the new F-150. The Ford Fusion was coming on. They had a truckload of cash on the balance sheet, and they just termed out their bank debt into longer dated debt. We took a step back and said, that doesn't look like a losing strategy. It actually looks like a winning strategy. And it's fun. I'm a little bit of a car buff. Ford, we were buying into Ford at $2.89, which happened to be the size of the V8 engine in the 65 Mustang was at $2.89. So maybe it was
That's
divine
right.
intervention. Who knows?
We would all love to have more divine intervention for sure, but
Take it when you can get it.
But you need to have a process. It needs to be repeatable. Obviously, we just went through a very challenging environment.
Sure.
Testing a lot of those processes that managers have had in place that I'm sure have done very well over historical periods. How do you think about that ability for a manager to adapt?
I think it's important to take in new information and to understand, has something fundamentally changed? And as an analyst, and I think whether you are truly working as an analyst, a portfolio manager, or if you're sitting in a CIO seat, all of us are analysts at heart. More often than not, the question is, what's different this time? The reality is, the usual reply is not much. And I think for many people that started to chase, for example, if you began chasing the Magnificent Seven, I said this to one of the young guys on the desk, NVIDIA, which has been a tremendous stock, but it's had 4 or 5 times in its life cycle where it's had 50% plus corrections.
That's right.
And if you're on the wrong side of that, that can be a very painful lesson. So I think it's important to understand what drives your philosophy. What do you believe is going to make a great company over time? And the interesting thing is, forget about even active management. If you take the Russell 1000 value and look at it relative to the Russell 1000 growth over long periods of time, what you'll find out is the indices end up a lot of times roughly in the same spot. It's just the value path will have, higher lows and lower highs, right? It's not quite as exciting of a ride.
Yeah.
But I think for investors, because particularly in a pension fund or an insurance company where you do have cash flows going out, having allocations to the variety of strategies is immensely important, because you want to be able to focus on what's doing well now, right? take money from that which is done best. And I think that continues to dictate for a very broad strategy where you're using international, you're using small cap, you're using growth and value. You're using fixed income of longer dated bonds, shorter dated bonds. You have alternatives because at any given moment, something is going to be in favor, something's going to be out of favor, and you can really ride that.
Everything that you shared, I'm guessing you're not getting this just from data. I'm sure data supports and validates what you're evaluating in a manager, but talk to us about that investment manager engagement, like how you're forming that relationship, how long that takes for you to understand their biases, to understand their process. So if they do underperform in a given cycle, you understand why.
I think you just hit on the toughest thing when you're employing third-party firms, the sell discipline. Every strategy, I don't care who you are or how you manage money, every strategy is out of favor at a given moment, right? Nothing is all weather all the time. So what we try to understand is the why, the philosophy. Why are you doing what are you doing? What are the things that you believe? And how do they go about analyzing that? And I like to visit with managers on site. I like to see how do the portfolio managers interact with the analysts? And what's the traders say? Does the trader have big input or are they just execution? Some firms are looking at their traders to understand patterns or how does this company trade in this kind of environment? And to me, the very best firms are those that are incorporating analytical data, trading data, both qualitative and quantitative, into that investment decision. I like people that establish targets. They'll say, look, for us, value is X. Now, for some people, they say, hey, when we hit X, we're out. Others will say, hey, when we hit X, that's a point of evaluation. And I think both are valid, but understanding philosophically what they do first. So that to me, philosophy comes first. Then it's the process, the people, the performance. But I think understanding why someone does what they do, that becomes the foundation of the building blocks for your evaluation process to think about whether or not they're a fit.
So maybe you can take us through an example then from the point where you start that conversation to understand their philosophy, then the underwriting process. So again, from sourcing to underwriting, if you just walk us through what that process looks like on your end, that'd be helpful.
So if we're doing the underlying, if it's for a manager that we're hiring, let's say for the general account, where we're leading the research as opposed to the pension, where we may rely a little more on our outside consultant. Again, we're starting with, okay, what are they doing? And what's the philosophy? What are they trying to generate? What is the alpha they're getting after? Once we can understand it, I think our next piece is, can that be replicated? Was it a one-trick pony? Did they find a trade or an environment that worked for a magic minute, but isn't necessarily so valid in the future? If we can convince ourselves through our research that it is a process that we think can be replicated, then okay, now we're on to something. We've got a philosophy we believe in. We believe it can be replicated. Now we're going to dig into the research. And again, with the people. The other thing we really try to avoid is the star system. Yeah. Our internally managed teams are there trading and managing money. I'm proud to say I think I built a strong enough team that God forbid something happens to me, I think they pick up the next day. But particularly many years ago, the star system was more alive and well. I think as we've moved on, particularly with the rapidity of information, I think we've ended up more in an environment where teams matter more. Yeah. And I would suggest that I think that's a much better way for manager selection.
Yeah. So I'm hearing a lot of what you would deem to be a necessity for you to continue the conversation, to evaluate that manager, underwrite, ultimately allocate. In terms of process, philosophy, process, there needs to be a team approach. Are there other aspects that would jump out at you when evaluating a manager in terms of maybe alignment within their business, their focus, anything else that you would draw out as being something that you would attract you to really want to do more work on that firm?
I think two things. One, if you do not believe as a sponsor that the person that you're hiring, if you do not believe and accept their philosophy, you should never hire them. The reason is for something I said earlier. every strategy is going to have its period where it's underperforming. And if you don't believe that your manager has a smart and intelligent process for making money, you'll be more likely to sell them when they're out of favor, and it could be the worst possible time. I think the other thing that we like to focus on is understanding the sort of pattern of return. When does this manager outperform? When does this manager underperform? And is there a consistency to it? And I'll turn it back on us for a moment. Our bond strategies tend to be underweight treasuries and overweight spread sectors. So when we're out on the third-party business pitching to institutional investors, I'll often tell them, if you're in an environment where the treasury sector is the leading sector, we will underperform. And I know that, and I feel it's important to put it out there. But I do like to understand what are the kinds of environments where managers perform well, and to make sure when the sun is shining, are they performing well?
Right. So that monitoring and making sure that the performance expectations, those patterns that you analyze, that they're actually connecting to the actual environment itself.
Exactly.
And doing what they're supposed to do when.
Precisely.
Yeah.
Precisely.
Right.
Tony, I have a question for you. As a faith-based institution, taking all of that into context, you're integrating Catholic values into the portfolio. The first question is how you do that. So what does that process look like? And then the add-on is, as an external manager looking to work with you all, how do you advise those managers to approach the mission as it relates to those values?
So the first part, if you were to walk into our trading room, what you would find is that our people are CFAs and MBAs, and they're finance people. They're not moral theologians. So we utilize an outside screening service, but we also have on retainer a professor of moral theology at the Catholic University of America. So Professor John Grabowski has been an advisor to us. And what John does, he does two things. One, he helps take the teachings of the United States Conference of Catholic Bishops, and that really is the distillation of Catholic teaching in the U.S. And he takes those teachings and distills them into investment rules. Then those investment rules are given to a screening service that then takes all of the publicly traded securities and gives us the exclusion list. And then our compliance people put them in. So we do not create Catholic doctrine. We follow it. The Knights are, we feel that we're in a position best to say that's what Catholic teaching is. So we follow it and adhere to it. And we use this outside structure. And it actually works pretty well. What we do for our pension managers, for example, any external manager, is that they can subscribe to that screening list. And I will tell you, I've not met a compliance officer at an external manager that has said, oh no, we don't want that. Right? They absolutely want it. And it gets scrubbed every 90 days. So we're never more than 90 days from reviewing it. And it's been very effective. For managers that are approaching us, I would say it's most important that they're open to understanding how we think about screening, and that they work with us to subscribe to the screening process. And I would say we've had one error with an external manager since we put this in place in 2002. And it was in 2006, and it was Viacom that was screened for adult entertainment. And as you know, Viacom has two classes of share classes. And I'm still old school. I look at the trade blotter every day. Now I look at it on my iPad. I used to literally get the trade blotter and we go line by line. And there was Viacom B. And after the blood drained, we called the manager. They'd purchased it the day before. And I think we had something like a $375 profit. So we just disgorged the profit to charity. And that literally has been it. So it's been a great process.
How about in private markets, private equity? So you've got a private company that doesn't have necessarily the disclosures that would hit that restricted list. How do you evaluate those companies?
So we will look at managers. We have a large senior debt strategy that we use with Audax out of New York. And at the time we were evaluating them, we worked with them to look at all of the loans, and it was over 500 loans. It was like 550 loans that they had made when we were evaluating. And when we went back through their whole track record, only 3 would have fallen out. So to the earlier discussion of being able to replicate was, well, if 550 they bought and 547 are in, we're pretty sure they can do this again. We have side letters with our alt managers that will carve us out of things, but we find that we just avoid the sectors that are going to be problematic. And for us, it's really biotech. Catholic guidelines keep you away from things related to abortion, contraceptives, embryonic stem cell research, human cloning. Now, there's not a whole lot of investments in human cloning that are in the markets we trade. Where do we run into it? Embryonic stem cell research, abortifacients, and contraceptives. So mainly that's big pharma. So what do? Stay away from biotech funds. Yeah. And if you stay in the broad-based funds, generally, particularly if they're in industrials or they're doing lending, they're generally not in the areas that would be problematic for us. And it really hasn't been a problem. And I follow up with our managers all the time, and they're telling me it hasn't been a problem. And if anything, once they're running money for us, they can run around and say, see, we do this for the Knights of Columbus. So we get it. And now, you, Diocese of fill in the blank, should do business with us as well.
Thank you for sharing that. How about vehicle preferences? Historically, if it was a faith-based institution, it tended to warrant more separate accounts than it did commingled funds for the reasons that you described. More side letters, just more, administration. Do you have a preference in terms of vehicles? So if a manager is calling you separate account versus a commingled fund versus a mutual fund, for example?
So generally, we're large enough, even on the pension side, even at 800 million, that we can write checks large enough to have separate accounts. In our previous incarnation, when the pension fund was much smaller, we were not we were not managing equities internally ourselves at that time. So we would fund a manager for the general account, and then they would run a smaller pension account for us. We generally do not invest in hedge funds because they're opaque by their very nature, and most are still not going to give you daily transparency. So we will avoid those where we can't get the full transparency. I have to tell you, in private equity, in the kinds of funds that we're looking at, private debt, we haven't had a problem. So people have been very game to work with us. And right now, and you may have noticed, faith-based investing is kind of having a magic minute right now. So there's a lot of vehicles and a lot of managers that are paying more close attention to it today than ever in the past.
Thanks, Tony. Thanks for sharing.
Sure.
Tony, just given your size and the amount of assets you're typically putting to work and given asset classes, how do you think about emerging managers?
We like emerging managers in the construct of where we can, again, see all those things that we mentioned. And there's a manager on the alternative side, a group called Fidelis, and they do regulatory capital trades. They buy blocks of whole loans from banks. And it was a small shop. They moved from working with a group. It was basically a family office, a single family office, went to a larger organization. It wasn't working out for them. They wanted to leave. We provided investment capital to manage on our behalf, and we've watched them grow into a pretty significant organization. We've done the same with a long-short equity strategy that we helped seed. It's a group called L2 out of Massachusetts. So we do like emerging managers but we have to see all of those other things. Yeah. The ability to replicate their strategy. How have they performed, even if we understand what their track record was like in a predecessor organization?
Are there certain asset classes that you would almost lean towards an emerging manager, just given the fact that they are small, they're probably more nimble, there might be an extra motivation there, obviously, just given their life cycle as an investment firm. So are there certain asset classes where you think they might carry more of an edge?
I think two areas for us could be equities, publicly traded equities, but also in alts. And I have this discussion all the time with my brethren of CIOs at large insurance companies. And, we'll pick on the behemoths like a New York Life or a Mass Mutual. They are so large that if we find a niche idea where we could put $50 million to work or $100 million to work, that still matters when your general account is $30 billion. When your general account's $1 trillion, those trades aren't there anymore. So I love our size because we're large enough that we garner pretty significant attention, but still small enough that niche ideas still can move the needle, and it makes it fun.
But how do you think about then that balance between not being too much of a representation of the strategy, if they are merging, if they're smaller, if they're in more of a niche market because there's capacity constraints, but it still needs to be a meaningful enough allocation for you. So how do you reconcile that balance?
So we can write tickets where I would say it's still meaningful for us down in the 10 or 15 million range. And so generally it's got to be a strategy that someone can have, I would say at the low end, 75 million to 100 million. We're actually in the process now of funding a manager, a real estate manager, who had been traditionally focused on a property or properties and would raise money. And now they're transitioning to a fund. And we worked with them on some direct property purchases, believe in what they're doing, have seen the replicability of what they do. And we're going to help seed or fund their now fund Roman numeral uno. So that's kind
really
of fun
cool.
too.
I love that. That's really cool. That's
and for
great.
you and I, he's Italian.
That's
so
right.
Fits right in. But that's not a criteria for investments.
It may help. It may not a criteria.
Exactly.
I was going to joke around that when you're approaching a faith-based institution that's Catholic oriented, usually you send the guy with a vowel at the end of his name. And that's how they initially start the sales process.
But I would say this too. It's interesting that we find also organizations that are attracted by the things that we do. And yes, the Knights of Columbus we're the largest Catholic lay organization in the world, but we do a lot of really good things that are agnostic to anyone's individual religion. We've had a coach program for many, many years, and we actually just gave away our current Supreme Knight, Patrick Kelly, gave away our 1 millionth coat in Colorado this past year. We have a longstanding program, Food for Families, and there's no litmus test. You don't need to be Christian. You don't need to be Catholic. You need to be in need. And for me, that's one of the cool things about working for the Knights. And I will tell you, a lot of our external providers that are in secular organizations, they like knowing that they're running money for an organization where the profitability is going to support some pretty needy things.
That's wonderful, Tony. Thank you for sharing that. You did mention real estate. What else are you working on today? Any other asset classes that are standing out where you've got the pencil to the paper?
We're looking at water heavily. I was blown away. We invested in our first water fund. And you think of big public utilities for electrical. And we found out at the time there were something like 17,000 water utilities in the US. And literally a water utility might be, 10 square blocks. And when you have something that fragmented, it just screams opportunity. We had been somewhat early in self-storage. And 10 years ago, self-storage was about 65% dominated by mom and pops. And that meant that they owned like 5 sites. Fast forward to today, that's now flipped the other way. 65% is institutional. So I think areas that we're looking at, water, we think there's still opportunity there. And obviously the need for clean water is undebatable. But we were also very early in what people call workforce housing or Class B properties. And that's now becoming a more institutionalized trade. So we're constantly trying to look for those things where it hasn't been totally institutionalized yet, if I can frame it in that term, where we still think there's the ability to generate, outsized returns. And I think our size plays to the ability of still being able to do that.
How about where are you exercising caution today?
We've been a little more cautious on public equity. Actually, in December, we started rebalancing away. Not because I'm a market timer. I don't believe in market timing, but I'm a value buyer, or in this case, a value seller. And we thought after 2 pretty tremendous years in equities, it would make great sense. Even in the pension fund, we took some money out of growth equity and shifted it into bonds, just saying, hey, look, trees don't grow to the sky. This seems like a good time. And I think that's an important point, I think, for all investors, something I would, to your listeners, setting targets and ranges, being judicious about taking profit. One of our largest clients that we work with is a charitable foundation. And every year at the beginning of the year, I work with them on what are your cash needs for the year. And for the previous 2 years, we literally created those cash needs in the early part of the year because the market was doing well. And it wasn't market timing. It was just saying, look, we have a lot of gain. We're overweight in certain sectors. Let's set you up for the rest of the year. And it allows you to be a long-term investor. In our pension fund right now, we have 18 months of benefit payments on hand in cash. And you can say, well, why are you holding so much cash? It's probably 3.5% of the plan. But during this downturn that we're having right now, we won't need to sell stocks to meet benefit payments. So I like to be intelligent about creating liquidity because I think that creates optionality for you as an investor. And I think that's amazingly important.
I appreciate that.
It doesn't force you to have to sell at the wrong times.
Precisely.
Yeah.
Before we get going, at least too far ahead, I wanted you to talk a little bit about your team, if you wouldn't mind. Just the folks, how they're arranged by asset class, what their responsibilities are, just so our asset managers and sales professionals who are listening in understand how best to approach the organization.
So we utilize our teams to actually evaluate the third-party managers that we hire. And I think we're unique for many people, although many insurance companies run money in-house and also hire external managers. On the bond side, we cleave the world in half. We think of everything through the lens of credit or structured. So structured being asset backs, mortgage backs, commercial mortgage backs, anything that's got a structure to it. And credit, I think, is fairly self.
Anything with a back.
Anything with a back. I'm more driven to credit because as you probably figured out, I'm more of a story guy, and I love the story about the management of the product or what are they doing. I know there's voodoo going on in my mortgage desk, but they're pretty good with the math and we love what they do. On the equity side, we're organized by strategy. So large growth, large value, small cap, international equity, and then we have a REIT strategy. And so if we're looking at a real estate strategy on the alt side, for example, we'll use our REIT equity team that's housed in our office in Boston and our REIT debt team that's in New Haven, and we'll bring them to bear on the diligence. So it's kind of a benefit to be a manager of assets because we have really good pros that can focus.
Yeah. Tell us a story. Tell us a story of a manager who called on you trying to sell a product, trying to sell a strategy. They get the meeting. What differentiates them from the others?
So for me, it's their story. And I like to understand their background, their philosophy. For me, it always goes back to the why you do what you do and the how you do what you do. And if we can viscerally understand that, then that's a manager we'll go sort of next level with. It's an old example, but it doesn't get tired because of the impact of it. Back in the days when Enron was a darling, we avoided it. And I would love to tell you that we were geniuses and we knew there was fraud. We didn't. But what we knew is we couldn't figure out the trading model. And my dad, as I mentioned earlier, my father he's still with us, but he was an electrician by trade, but he was also a real estate investor. And one of the things I heard from him a million times from the real estate side, but has played well in my investment life, is there's always another day, there's always another deal. So if we can't understand a process or philosophy, or in the case of Enron, their trading strategy, we just run the other way because there's always something else. So I think for anyone approaching us, have your story and have your story tight. And it starts for us the why you do what you do and the how you do what you do. And we need to make sure, I always say, if I can trace $1 through the front door of a company all the way through its process and to the bottom line, that's a company I'm interested in. For a manager, if I can trace that dollar through the sales process into your portfolio and understand the buy process, the maintenance process, and potentially, most importantly, the sell process, that's a manager we can get our arms around.
I appreciate that. Thank you for sharing. I don't want to let you go without asking about risk management. I hate that we always wait until the end to talk about risk management. And my father would be upset if I didn't quote St. Thomas Aquinas in a conversation with the Knights of Columbus. So if the highest aim of a captain were to preserve his ship, he would keep it in port forever. So how do you think about risk management? How do you think about taking those risks in the portfolio while still wanting to, receive that upside potential?
No, it's a great question. And when I'm thinking about it from the insurance context, if you think about it, insurance companies, by their very nature, are taking risk. every insurance policy that we issue, somebody underwrote risk for somebody. If it's a property and casualty company, obviously with the weather events we've been having, clearly they're doing the same. On the pension side, we have to hedge longevity. And yes, it would feel awfully good to have no volatility and be in T-bills and life is good. And I would always say my blood pressure and my golf handicap would be lower. One is contained by medication and the other one seems stubbornly stuck at 13. And that's because I need to take risk. So we think about trying to take risk in a diversified way. I think trying to understand the explicit risks that you're taking. Every investment has an implicit risk. If I'm overweight industrials, I'm underweight finance. If I'm overweight, pick a sector, I'm underweight something else. So we think it's important that you understand your explicit risks, but we think it's equally important to then understand the implicit risks. If you were overweight, you're underweight. Well, if you meant to be overweight something, make sure you understand what you're underweight. If you decide that you're going to be barbelled in duration, understand what that means if the middle part of the curve works against you. So I think we try to think about risks in understanding and quantifying the explicit risks that we're taking, but then to make sure that our implicit biases don't overtake the portfolio.
How about some advice? We always like to ask our guests for some advice, particularly for our younger listeners. We all three of us have a lot of gray hair now on our heads.
Gray and leaving.
Gray
right?
and leaving. So those that are coming into the industry, how do you advise those?
I would say this. I think for young people, we didn't create the rules, but as you know, you can cross the Rubicon from the investment side to the sales side, but it's pretty hard to go back the other way. So I would say early in your career, you can jump over that line. Make sure you understand what motivates you. If you like to be client facing but you're interested in investing, that client portfolio role, right? Being that client facing piece could be very interesting. If you're in sales, I think for me, the salespeople that have resonated have been few places, and they have conviction in what they're selling, and they don't waste my time. So they'll call me with products and philosophies that they think will resonate. And for those people, I take those meetings every time. But if you're jumping, company to company to company, it's hard to get that credibility. And I actually saw an article I read yesterday talking about the fact that the old saw of, you should job hop because that's going to generate more income for you, may actually be turning away right now. So I think in much the way we were talking about investments, find a firm that resonates with you, whose process and philosophy matters, whose mores line up with you. And I think you can end up in a great career. It's a blessing to be in this career, in this industry, because we're learning something new every day. The markets change, new companies come along, new strategies evolve. And I think to the best we can keep ourselves young, we do by learning about these things.
No, I appreciate that.
That's great.
One last thing. You did say you like to unwind with a novel. Anything you're reading now that you would recommend for us?
It's interesting. I'm reading an older book. It's written by Selvin Robb, and it's The Five Families, and it's actually the history of the mafia in the U.S. I'm intrigued by true crime. I just also reread one of the books on Madoff. I was so fascinated by Bernie Madoff, just that A, abject evil, B, the length of time. And if I could tell a super quick story real quick, the Boston office of the SEC was the first group that came to audit Knights of Columbus Asset Advisors. And I sat in on all the meetings, and the lead asked me, he said, I found it interesting that the president of the organization is hands-on involved in sitting in. I said, well, unfortunately, Hebrew National got the quote before we did, but we do answer to a higher authority. I said, but my question is really back to you. It seems like the Boston office of the SEC figured out Madoff. New York didn't react, and the rest of us are going to pay for it. And he started laughing. He goes, Yeah, pretty much. So those are the kinds of things that resonate. But this book on the mafia is pretty fascinating.
Yeah, I remember you had mentioned the mafia. It was interesting. It had me remember where I grew up. When I was 5 years old, Nicky Scarfo put a hit out on Phil the plumber Salerno. And the Salerno family lived a couple blocks down from where I lived. So some guy in the middle of the night walked up to their hotel, knocked on the window, and tried to take out his family. So Wildwood and the Jersey Shore, as we know from Atlantic City down, has a lot of history. I used to be very interested. I still am very interested in as well. I was happy you were too.
Yeah. Oh, no, it's always an interesting read and colorful characters. But I think for me, it's the balance of the good and evil and sort of understanding all of that. And I think that's what has attracted me to it.
Well, a lot of good lessons in that, a lot of good lessons today speaking with you. Thank you so much for this. We really appreciate it. Thank you for your time and congratulations on all your success.
And thank you for having me. It was a lot of fun being here with both of you today. Thank you.
Yeah, great being with you.
Dan, thank you as always for being here. Always a pleasure. If you want to learn more about Tony and the Knights of Columbus Asset Advisors, please visit their website at www.kofcassetadvisors.org. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We're also available on YouTube if you prefer to watch while you listen. If you'd like to catch up on past episodes, check out our website at dakota.com. And finally, if you like what you're seeing and hearing, please feel free to follow, like, share these episodes. We welcome your feedback as well. Tony, again, thank you for being here in Philadelphia. Dan, thank you as always. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.